A lot of people buy gold as an inflation hedge and to hedge against the government stupidity and money printing. And it's to have something real, have something is going to hold its value, to maintain wealth. Now, some people may buy it as a speculation at times, but overall, its goal is to maintain purchasing power. And part of that is an inflation hedge. So we expect that when inflation goes up, well, so does the price of gold. However, this morning, the gold price was up about $10 an ounce. And then the inflation data came out, and it was what they call hotter than expected. Inflation rate was higher than was expected. And what happened to the price of gold right after that? Well, the algos came in and started selling the heck out of it. And at one point, it was down about $40 from the high. Now, what good is an inflation hedge if it goes down when inflation is higher than expected? Now, unfortunately, today we're in this weird world where all the big traders are trading stuff based on what they think the Federal Reserve is going to do next. So when inflation is higher than expected, the price of gold goes down when the price of gold should be going up. And then on the other hand, when inflation is lower than expected, the price of gold goes up when it should be going down. Now, that doesn't really make any sense because when you have an inflation hedge, it should go up when inflation is higher. However, because these big traders are looking at what the Fed is going to do, they see, okay, inflation was higher than expected. So now the Fed could raise rates, or now the Fed will wait longer before they start lowering rates. And since rates are going to be higher than we previously expected, we have to sell gold because high rates are bad for gold. That's what they're thinking when creating these algorithms. And the opposite is true. When inflation data comes in lower than expected, they say, okay, we should buy gold. We should have the algorithms buy gold because the Fed is more likely to cut rates or leave rates lower for longer. So it's all backwards. The price of gold should go up when inflation is higher, and the price of gold should go down when inflation is lower. But because the markets are forward looking and they're looking at what the Federal Reserve is going to do with interest rates, that's basically all that matters in today's world, at least in the short term trading. Now, I mean, you go look at a longer term chart and you can see gold going up pretty steadily over the last many years. And what has happened in the same time to the dollar? Dollar has gone in the opposite way. The value of the dollar has gone down and down and down pretty steadily over time. So does this mean that gold is worthless as an inflation hedge because it goes lower when inflation is higher? Now, I don't think so. When you hold an ounce of gold, you have something real. You have something that's going to maintain its purchasing power. And when we step back away from these daily moves and we look at the longer term charts and we look at what's happening in the longer term, gold is maintaining its purchasing power. Gold is going up when the dollar's going lower. It's just on these days when we see inflation that's higher than expected or lower than expected, gold does the opposite of what it should do. However, in the longer term, gold is doing exactly what it's supposed to do, preserving your purchasing power.